South Africa has submitted a revised trade and investment proposal to the U.S. That's after taking into account feedback from the U.S. Trade Representative. Minister of Trade, Industry and Competition Park Staal is currently in the U.S. engaging on the matter and says the reworked proposal focuses on expanding trade and investment relations between the two nations. Staal cited South Africa's impending gas shortage and the country's appetite to source LNG from the U.S. as an example. He added that the proposal also included provisions related to the African Growth and Opportunity Act, known as AGOA, which is currently under consideration for reauthorization by the U.S. Congress. Government will have to cut spending if Sars doesn't meet its revenue target. That's according to Finance Minister Enoch Godongwana, who spoke to Reuters in an online interview. The comment follows the presentation of the national budget, where Godongwana made only minor adjustments to the state's expenditure plans. That's despite having to cut a proposed VAT hike, which has left a revenue hole. Government has agreed to give Transnet a 51 billion rand guarantee facility. The ailing state-owned logistics firm says the support will allow it to build on progress with strategic rail and port reforms. The package is made up of a 41 billion rand guarantee for the firm's funding requirements for the next 2 financial years and a 10 billion rand guarantee to help service debt and make capital investments. Transnet has struggled to provide adequate freight, rail and port services for years because of equipment shortages and maintenance backlogs linked to underinvestment, with cable theft and vandalism also damaging the rail network. Motorists could still be in for some relief at petrol pumps in June. That's even as a hike in the fuel levy comes into effect. Finance Minister Enoch Godongwana announced in his budget speech that the general fuel levy would increase by 16 cents a litre for petrol and 15 cents for diesel from the 4th of June. This is the first adjustment to the levy in 3 years, but the rand's strength and lower oil prices could soften the blow and still allow for fuel costs to be reduced. Meanwhile, the Road Freight Association has pushed back against the fuel levy hike. The body says the move will be felt directly by consumers. That's as transporters cannot absorb the increase without detrimental effects on their bottom line. The RFA CEO Gavin Kelly says the decision underscores that Treasury would rather tax citizens than cut wasteful expenditure. Investec has reported a strong performance in a volatile operating environment. That's according to the group's CEO Fani Didi. Pre-provision adjusted operating profit for the year to end March grew 7.8%, pushing the figure to over £1 billion for the first time in the company's history. Revenue ticked up 5%, supported by client acquisition and entrenchment strategies and strong net inflows in discretionary and annuity funds under management. Headline earnings per share came in flat at 72.6 pence. A final dividend of 20 pence per share has been declared. That brings the total for the year to 36.5 pence. Life Healthcare has reported a strong operating performance at the halfway stage of its financial year. That's thanks to robust activity growth and benefits from acquisitions concluded in the second half of 2024. Revenue rose 8%, while normalized earnings per share from continuing operations were 9% higher. An interim dividend of 21 cents per share has been declared. That reflects a 10.5% increase on the previous period's payout. Teresa has announced a second share buyback scheme. That's in an effort to return value to shareholders after a challenging first half. Details of the move have not been provided, but a statement from the PGM miner says it sees incredible value in the initiative. In March last year, the group unveiled a plan to buy up to 10% of its shares in issue for up to $5 million. Another buyback may offer some relief to the miner's share price, which has given up over 10% since the start of this year. The dip in Teresa's share price comes as the group has reported a 78% plunge in interim headline earnings per share. That's as poor weather conditions and weaker chrome prices weighed. Further afield, Walmart, a leading U.S. retail indicator, intends to eliminate approximately 1,500 positions as part of a broader effort to streamline its operations through restructuring. Let's take a look for more detail.
Walmart is set to cut around 1,500 jobs. That's according to a memo seen by Reuters. It's a part of a push to simplify operations at the retail giant. The plan will hit teams working in global technology operations and e-commerce fulfillment, as well as the Walmart Connect advertising business. Walmart is a bellwether for the retail sector and the country's largest private employer, with some 1.6 million staff in the U.S. It's also the country's biggest importer, with about 60% of those imports coming from China. That has recently put it on collision course with Donald Trump. He told the firm it should eat the cost of tariffs after Walmart warned that steep duties on Chinese goods would force it to raise prices. The company said those increases would start kicking in from the end of May. It said it was working with suppliers to find substitute goods that are less affected by the levies. But it said that was challenging for goods, including some fresh produce, where it is dependent on imports. Earlier this year, Walmart cut some roles and closed an office in North Carolina as part of a move to focus on its main hubs in California and Arkansas.
And Nestlé is shifting its focus back to its core business, moving away from non-core areas like health supplements that had a negative impact on the company's overall structure. Here's more detail in this report.
Swiss food giant Nestlé will refocus on its core business after diversification into different types of products, quote, weakened the fabric of the company. That's according to its boss, Laurent Frechet, who took over the company in September. He told the Financial Times that straying into segments like health supplements meant its core brands in coffee, pet care and food were neglected. He said he only saw merits in slimming down the group's portfolio in places where Nestlé wasn't in a position to win. In another interview earlier this week, Frechet revealed that Nestlé, owner of brands including Nescafé and Kit Kat, is recovering market share in the US. That's despite concerns of impact from President Donald Trump's trade tariffs and American consumers feeling unsettled by a slowdown in the economy. Leading with an attitude that, quote, M&A is not the strategy, Frechet branded Nestlé as on the right track.